It's no secret that Vancouver's housing market is one of the most challenging markets we've seen in decades. But what a lot of people aren't paying as close attention to is what's happening in the mortgage market and how people's financial strategies need to shift in this market. With lending scenarios becoming more complex, the market shifting, and different regulation changes, it's more complicated than ever to make sure that you're getting the right mortgage strategy. I'm Adina with Adina, YVR Vancouver Real Estate Group and Oakland Realty. I've been a realtor for 15 years, helping clients buy and sell properties here in Vancouver. So to talk about some of the challenges and opportunities we're seeing in the market, we have an amazing guest here today, Stephanie Camps from RBC Mortgages. She's one of the top mortgage specialists in the country. She's been a mortgage specialist for over 15 years, and she's been in the banking industry for over 2 decades. And we're going to dive into some of the challenges we're seeing right now and how smart buyers and homeowners are taking advantage of these opportunities to get ahead in this market. Okay, let's jump into it, Stephanie. So everyone's talking right now about mortgages, what's happening with rates. We're seeing a lot of deals fall apart on financing. We have a big mortgage renewal wave coming up. What challenges are you seeing right now in the market?
So biggest thing that we're seeing, couple things. One, housing affordability, right? Yes, prices have come down from the peak. Interest rates have come down. But if we look at interest rates today compared to, say, 2021 or 2022, fixed rates are still probably double where they were. If you're looking at a variable rate, probably 2.5 times where they were from July 2021. So interest rates are still high, right? So one of the biggest things that we're seeing is people that have mortgage renewals that are coming up. About 30% of homeowners are going to renew at higher interest rates. And actually about 10% of those are going to renew at rates 40 to 45% higher than their current payments today.
Wow. So what are you seeing with that? Because I think a few years ago, there was a fear about, okay, all these renewals are coming up. People are going to the people just can't afford it, but people can technically afford it because of the what's it called, the
stress test,
right? But what are you seeing? Are people coming up and they're going, hey, we can't afford it, we need to extend our amortization, or what are people doing right now?
I don't find the renewal wave has been as catastrophic as a lot of people are making it out to be. I think people staying in their homes, making their mortgage payments is going to be the first priority.
Right.
First, people are going to look at cutting out vacations. Are you going to cut out eating out, all that discretionary spending first? And ultimately, people want to stay in their home, right? But we are seeing a lot of clients, whether you have other debt you want to consolidate, getting rid of other payments, extending amortizations back out to a 25 or 30-year amortization, just to keep that payment increase as minimal as possible. So not the ideal scenario in a way, because clients are going to be taking a longer time to pay off your loan. You're going to be paying more interest. But if cash flow today is the most important and really getting that lowest payment, a lot of people will have options. And especially clients that had those low fixed rates over the last, let's say, 5 years, and they focused on paying down those mortgage balances. They've made principal payments. Those people that had made those extra payments during those low interest rates really are in a better position because they have flexibility to extend those amortizations.
What percentage of people, from what people you see, how many of them were actually using that opportunity to pay down their mortgages versus how many were just riding it?
Maybe a quarter, I would say. Okay. It's not a lot, right? Yeah. But I would say most people are going to be resilient. I think another challenge that we're really seeing is that people who kind of bought in that peak 2021, 2022, maybe those people don't have that same flexibility because home values aren't there, right? Likely today their house price is going to be less. And if they took out a mortgage with a minimum 20% down payment, they don't have the equity to be able to refinance to add another debt, right?
Yeah.
So if you bought prior to the peak and you've been paying down your mortgage, you have more options than the people who bought in the last 5 years and haven't built up that equity.
Yeah. And we've seen that too. I don't know how much you've seen it, but clients who have been in their homes for 5, even more than that, and they want to move up.
Yeah.
They're making more money.
Yeah.
They think they can increase their price point, but now that they're looking at where rates are, they realize that they actually can't move up the property ladder because they just can't afford the higher price and the higher interest payment.
Yeah.
Are you seeing that with people?
Yeah. A lot, right? And I think people are making way more calculated decisions now, partly because the urgency isn't there with the market. We don't have that FOMO piece. And I think it's a good thing. I think we have clients where they did a pre-approval 2.5, 3 years ago. They're still shopping for that detached house because they're waiting for that right property to come along. And now it's not just about what can I afford, but can we sustain these payments?
Yeah.
Because now part of the conversation is like job stability.
Yeah.
And this isn't something that we looked at or talked a lot about prior with clients 5 years ago, right? So whether a client works in tech or you have a professional job or you're worried about your job being optimized by technology, I have lots of clients in high power jobs, high income earning jobs that say, hey, my job's probably going to be gone in the next 5 or 10 years. So I need to be able to pay off this mortgage in a faster time frame because I'm likely going to have a lower income or not have an income within the next decade. And these were not conversations that we had a while ago.
And you're right. I think that's the gift of this market, that it forces, when you have a challenging market, it forces people to be more strategic and think ahead and realize there is risk, right? Up until really 2022 or up until COVID, when we had the shock, everyone just thought prices go up forever. Prices were doubling every 10 years in Vancouver. People didn't really think twice about it. You were a lot better off just buying and not even thinking, just buying anything almost and not thinking about it than you were by overthinking it and not buying. And now in this challenging market, people really have to think about what are they doing, right? And how sustainable is this? And what happens if prices don't go up? Do you still want to live here?
Exactly, right? Exactly. And the risk versus reward. And I find a lot more people now are making way more conservative decisions, which isn't a bad thing, right? Like, can we stick in this townhouse? Maybe it's a bit tight on space versus the jump to going to detached when we're worried about job stability or affordability, right? And I also think with aging population of parents, lots of people we see now are helping care for parents. That's an additional cost, right?
Yeah. And we're seeing a lot of, actually, I don't know if you're seeing this with your clients, but we're seeing a lot more people starting to want to be closer to their parents, but also living with their parents, like trying to co-buy with their parents if they're going to make that move up, is thinking intentionally, and is this a house that we could all live in together for a long time? Does it have, which those houses are really hard to find in Vancouver. A lot easier in the suburbs. But are you seeing that with your clients?
A lot more, and lots of times it's like, are they going to buy a house? They're going to build a carriage house. Maybe the carriage house would be for the parents to live in, have them close, or like a suite, or just like a multi-generational family in one house. A lot more, I think, affordability for sure, but also it's just the lifestyle of having parents built in, having support for their kids, and then taking care of their parents. So benefits all around.
I think it's a return back to fundamentals of housing. And then, so mortgage renewal, we talked about that there's over, 1 million mortgages coming up for renewal this year. A lot of people are panicked. You don't think it's going to be as bad as everyone's?
I don't think it's going to be as bad. I think like some of the stats that I had read is that about 30% of mortgages are going to be renewing at higher interest rates and higher payments. Sorry, not interest rates, but payments. And then typically there is going to be that small portion that's going to have a 40 or 45% payment increase. I think, again, a lot of people in Vancouver, not everybody bought in the last 5 years. People that bought prior and have that built up equity would have other means to be able to like get payments down. I have a couple clients right now that we're helping where they had car loans, they had some student loan debt, all at higher interest rates. And we were able to consolidate all those payments. And on a detached house in Vancouver, payments are only going up $500 a month, right? And so for them, even after all their other payments, it is manageable. It's just more looking outside the box and looking at that full picture and looking at those amortizations and looking at what are the aspects and things that we can do. And there's going to be pros and cons with both. But now with people renewing at higher rates, I think people need to shop around because rates are so volatile between every single lender. It's not like when I started this job 20 years ago, you'd go to a bank and have a rate sheet, right? And every bank has a rate sheet and these are the best rates we can do. It's not that way anymore, right?
How does it work now?
There's going to be, a rate sheet, and then there's going to be discretionary pricing based on what that client's relationship is with that bank. Obviously, if you have a primary institution, they're likely going to give better rates than if you're going to a new bank. And secondly, every bank's just pricing is different depending on what their deposit level is, what their risk tolerance is, how much they want to grow their mortgage book in that year or quarter. So I really think people need to start shopping around 4 months out from renewal. And you need to aggressively shop because you know what? People work hard for their income and hard for their money. They need to ensure that they have a mortgage that's going to not just get the best rate, but have somebody advocate for them and look at all of the options just to minimize those payment increases.
And would you say banks are one of the things we've heard is that it's harder to get financing. Are banks becoming more selective about who they're wanting to loan mortgages to, or are they becoming more aggressive where because I've kind of heard two things. One, they're becoming more aggressive. They're really trying to be more competitive against other banks to get more mortgages. But I'm also hearing that it's a lot harder for people to qualify, and they're not qualifying for what they could have a few years ago due to regulate. What are you seeing happening?
On the rate piece, for sure, I've never seen it so competitive. And I think it's twofold. One, we have a housing market with 20, 25-year lows in sales. So there's less people that are buying. And if we have less people that are buying, then obviously there's less transactions to go around for these lenders. Banks want to obviously lend money. That's how they're going to earn part of their revenue, right? So I find that the competition piece for rates and for clients is way more extreme because there's less transactions. And that's ultimately going to benefit the consumer, right? If they can shop around. I don't find, especially for RBC, that we're tighter or we're harder. I think lending as a whole is very different than where it was 10 years ago. Like when I started this job, you could get a notice of assessment or a T4 and get a mortgage, or you have stated income programs where you didn't have to verify income. Nowadays, I think with a lot of the OFC changes and more regulation on AML, way more documentation. But that's an industry piece. That's not a piece, I think, with a specific bank.
Not a bank. Okay.
Yeah. And like you guys too, you'd have more regulation changes too. And that just comes with the times. So I don't find, we're harder to lend. I know there are some changes with OFC. People were talking about double counting rental income. If you own multiple properties, we have lots of clients that own rental portfolios, and we haven't come across that. So that hasn't been an impact.
Yeah, that was a big freak out, and I think from Instagram last year. But when I talked to other mortgage reps, it wasn't an actual thing. So and so would you say banks are trying to be more aggressive? Is there certain types of clients that they're going after more? Like what kind of clients have more leverage? Is it if you're already with the bank? Is it certain credit scores? Is it certain amounts of mortgages? Or like what's the ideal client?
Most like institutions, whether you're a credit union or your banks and credit unions, lenders want full service clients, right? So typically like with mortgage spreads today, because rates are being discounted so low, like the spread that lenders would make on a mortgage is very minimal. And because it's so minimal, they typically want to be able to make up revenue in other products, whether clients have bank accounts, they have credit cards, they have business accounts, deposits, investments, right? So I would say if you're a consumer and you're shopping around, you really should be going to like your main institution first, where you have most of your banking, because that's going to give you your most leverage.
Because they don't want to lose you from those other products if they do. Do banks ever put conditions? I know I had a commercial mortgage years ago and switched it to another bank, but the condition was to move my banking over to that bank if they gave me the loan. Does that ever happen for residential loans?
Some banks that like they'll say, okay, well, we have X rate, our standard mortgage rate today, but we have a preferred rate or a package rate if you bring over your banking and your direct deposit for your payroll. So some banks I know have gone that way. And again, I think they just want the full relationship to be able to like earn that client's business.
Right. But RBC doesn't.
We don't have that,
One product at a time here. You go. And speaking of equity, we touched on that. I think you've mentioned this to me before, and I've seen it as well. One of the biggest challenges we're seeing in this market is that people were buying for equity gains, right? And the prices kept going up, and that gave them a lot of flexibility to move up in the market, buy second properties, do other. Now they don't have that, right? In the last 10 years, we haven't seen the price appreciate. In the last 5 years, we've seen negative appreciation for some properties. Like right now, we're seeing a lot of properties that are selling below what people bought them for in 2022, below what they bought them for in 2018. So it's obviously painful to be a seller in this market if you overpaid, but if you own property and you're refinancing, what are you seeing from those clients now? So it's a challenge, right? Because I think when we look at our generation, right, whether you're in your 30s or 40s and you bought a home in the last 10 years, right, let's say 2015 onwards, 2016, you've seen those price appreciations. And we talked about before that those people were using your house as an asset, right? And they were taking equity out, whether they're putting into investments, they're buying another investment property, they're doing renovations, putting a rental suite in your house for income producing. So they use their home to build wealth, right? Whether it's just through other streams than just their house. And it's a challenge now because people don't have that asset to leverage to do other stuff. Where like our parents' generation, you bought a home to live in. You weren't really buying a home to think about house appreciation. You think about, I'm going to save part of my income or build a pension and have RSPs and build that over long term. And your net worth really came from your savings of your earned income, right? So it's a big mind shift that we're seeing a lot of clients that you're right. Like
I bought a home in 2021 or 2020 even, pre-COVID, and it's now worth less, right?
Yeah.
So it's a big adjustment people have to make, and people are going to have to make an adjustment that maybe your home is just going to be a home to live in, right? It's not going to be something that you're going to supplement your lifestyle or income by.
Yeah. And I think to what we talked about before, in a way, it's a really positive thing because up to now, I think everyone in Vancouver thought they were an investor. Like anything you bought went up. So everyone thought they're like this wizard in real estate and they know what. And now they see with every investment, there's risk, right? Yeah. And if you bought your home not as an investment, but to live in, there really isn't much risk other than interest rates fluctuating.
Yeah.
But if you bought it for that speculative nature, like now you're seeing the downside and now you have to be more strategic about moving forward. Yeah. But I do think as we see that, the impact on the real estate market that's challenging is we've had an influx of listings in the last year, but a lot of those listings have actually been tenanted properties, right? So it's people who are selling their investment properties. For people who are living in their homes, if they're not seeing that appreciation, rates are higher, we might see listings go down. Like it's harder for them to sell and move up the market, right? So that impacts us on that side. And to your point, if they're paying higher for financing, it also impacts the whole economy because they're not having as much disposable income.
And exactly, all these renewals, right? If people are already kind of living somewhat paycheck to paycheck when you're living in Vancouver or Toronto, right?
Well, what were you saying the mortgage payments on a detached home in Vancouver, it's like 90% of people's income.
2025, the stat that I read came out said on a typical detached house, so probably not luxury, maybe a Vancouver special, 93% of somebody's median income on a detached house in Vancouver is going towards housing.
Yeah.
And if you look on a condo, you're at about 48%, right? So it just means that, people really weren't able to save, or even at these current low interest rates, right? When you have a 2% rate, and they're likely not going to be able to save or have that discretionary income to go to restaurants and tourism and do all the stuff locally in the economy if they're having their payments go up.
Yeah.
Right.
So how are you with that? There's still a lot of buyers getting into the market.
Yeah.
Like we have a wave of first-time buyers getting into the market. We still have a lot of people who have kids and, even though it's not easy to move up, they kind of have to move up. And it's actually a good time to move up, right? Yeah. Because you're not getting as high of a price on your sale, but you are going higher on you're saving. You're not getting as high of a price as you wanted on your sale, but you're saving more on your purchase.
The net gains there.
Yeah. So with the affordability challenges, even with that, we are seeing a lot of people getting into the market. And then we're seeing people who are still able to move up in the market, even though it's more challenging. They're getting less for their sale, but they're able to save on the purchase. But how are you seeing people make it work? Because what I'm starting to see is a lot of more family help, right? Like people are either getting help gifted from parents or people are passing on and they're getting inheritance. So we are starting to see a lot more of that coming in with our clients. Are you noticing that with clients too? Is that a big effect?
More, I would say kind of coming back to what we're seeing, a lot more first-time home buyers are getting in the market. Yeah. And we've had first-time home buyers that have been looking for 2 or 3 years. They're finally making that plunge now, I think, because one, there's so much more inventory that's come on. Yeah. They can write an offer with a longer subject period, not feel so rushed, really do their due diligence. Yeah. And then rates have come down. Yes, rates aren't COVID rates, but mortgage rates in the 3s are where rates were pre-COVID, right? Yeah. So if we look at rates kind of like January, February, early March 2020, 389, 399 were typically standard rates, right? So the affordability piece for sure. And I find also with that CMHC extension now on a 30-year amortization for first-time home buyers, that really helps as well. The first home savings account, people can take advantage of that to save up a bit more. So a lot more first-time home buyers probably than I've ever seen getting in the market.
Than ever, really. Yeah. We're seeing a lot too. I don't know if,
Yeah, and on the condo side, right? Probably condo, maybe townhouse. And then I would say a lot of people that are moving up. So like you said, yes, like maybe you're taking less of a price on a condo, but you can make it on a detached. I've had a couple clients actually sell condos in Olympic Village, other parts of East Van, and they ended up selling like 50, 60, 80 grand less than they actually bought it for. So they did take that loss, but you know what? Life events happen. And I think we have to remember that, yes, we don't have that investor piece in the market that really drove it or that foreign buyer, but people are still people and people are going to have life events, whether you're having your first kid, you're getting married, you're upgrading, you want more space, you're going to move in with parents, or you're retiring and downsizing. So we're going to have these lifestyle changes where people need to move, and that's never going to change whether a market is strong or not, right? So I think for clients that are looking to upgrade into like a detached, it is a great time because again, if you can get a really good price on a detached, I think if you have a stable job, you're not worried about your job being replaced by AI or something else, and you have the ability to make those payments in the long term and it's comfortable. We're seeing a lot more people get into detached, especially if you look on the west side, right?
Yeah.
The areas
Huge
like
discounts
that,
right now. Yeah. It's been interesting. And also on the east side, we're seeing more people getting into duplex, but it's like making that move into your long-term place and starting to think about the places.
Exactly.
Is this somewhere where you could live in 10, 15 years? And again, it's a return to fundamentals because I think the last few years people kept worrying about resale value and how much it's appreciated, which honestly, if your resale value increases, but you're buying into a market that's also increased, you're not that much better off. It was just helping you hedge against inflation. But really, the fundamental goal of real estate is that you're buying it and you're paying it off in 25 years and you have somewhere to live. And now people are starting to think more that way.
We're a lot more coming back to those fundamentals, whether it's a person on a pre-approval, whether it's somebody on a renewal. Exactly. Like you're talking, okay, I have 15 years of my working years or 20 years of working years left. Like what can I do and make these changes with my mortgage payments, with my lifestyle or like finances to be able to pay off those mortgages? And I think it's a good thing. We're coming back to again, those fundamentals of like making decisions that are really thought out. Long-term, exactly. Not speculative, not worried about, I can sell this property in 5 years and make a profit. Yeah.
And in a lot of ways, I think that's why, in a way, we're coming back to a much healthier market, even though it seems very doom and gloom. And for first-time buyers, like you said, it is very interesting because we're seeing more come in, right? Not enough to keep the condo market afloat. Because what's happened in the condo market up to now, and the segment of the condo markets that softened the most in the last year and a half has been the one-bedroom condos. And that was always the segment that was on fire because you always had first-time buyers and you always had investors and they were fighting for, property and very low inventory, and investors weren't selling. Now you're seeing a lot of investors selling because their payments are going up, but rents are they're either flat because you can't increase the rent on your tenant, or if they're losing their tenant, they're actually getting lower rents now, right? So investors, if anything, we're seeing more investors selling. We're not seeing very many investors buying. So it's freed up a lot of inventory in the one-bedroom condo market. And it's really those first-time buyers now have that selection. And they have the opportunities to buy stuff, like you said, in many cases, it's like 10% less than it was years ago.
Yeah, I've had several clients this year. I could probably think of at least 20 that owned, their primary residence, 2 or 3 rental properties. They've sold off those rental properties, some at a loss from 2018, 2019 prices, right? We're looking 6 years later, they've sold at a loss, but they're just doing it to simplify. You know what? I want to get rid of those tenants. Or tenants have moved out and then they've decided to sell, get rid of those mortgages, pay down my primary residence and come back just to those fundamentals, right?
And reduce the risk and just, pay off your equity.
And I would say probably for us, pre-COVID, 35% of my mortgage business was investors. People buying multiple rental properties, leveraging one, taking equity out. And really, I would think in the last year, maybe I'm doing 1 rental purchase a year. It's just not what people can afford. And most times it's not cash flowing. So why is somebody going to take a $1,500 or $1,000 a month loss per month to supplement a rental property that's likely not going to appreciate in value?
Totally. And that's, they say with investment property, you either get cash flow or you get appreciation. You really get, and Vancouver's never been a cash flow market. It's always been appreciation.
Totally.
But now we don't have appreciation.
Exactly.
So now there's really no reason to.
And even other areas, if you look in Okanagan or even Victoria, like what we've been seeing is most of those aren't cash flowing either. Right?
Yeah. Well, especially with the Airbnb changes and everything. So it is interesting. Same for us. I think we've had a lot more investors selling in the last few years than we typically do. Very few. I'm trying to think. Maybe we've had 1 or 2 in the last 2 years who have been buying condos, right? It's quite interesting. So, we talked about inflation. We've talked about affordability. What about people? Actually, I have a few questions. People buying second home. So I'm seeing less clients wanting to buy investment properties for pure investment. The numbers just don't make sense. And also, like you said, a lot of people who have an investment property and they ask me, should I sell it? And my answer is it's not. It's more of a financial advisor role to look at, okay, if you sell it, where else can you put your money?
Totally.
Right? My role is if you want to sell it, here's what your options are and here's how the market's looking. But typically everyone that's looking at that this year, it does make more sense to sell it and put it in stocks or other investments. But we are starting to see more clients thinking about buying a second property, like somewhere so that, people are traveling more locally. They want something closer to home rather than, doing all these worldly travels. Are you seeing that? Is it like,
Definitely.
what are the challenges with buying a second property, especially if you're trying to refinance your primary residence, or how do you see it playing out right now?
A lot more people that we're seeing are buying secondary places, whether it's Whistler, you're looking Okanagan, you're looking Sunshine Coast. Exactly, right? And probably more than I've seen the last 10 years, maybe partly in a response to people don't want to go to the States, right? I think with everything going on globally, maybe more people want to stay locally to home, or buying it with family, right? Whether you have a sibling or parents and you're going to pool your money together to buy a place, you're each going to use it a couple months of the year. A lot more of that for sure.
And what in terms of how, is it harder to qualify for second property? Is it as straightforward as your primary residence? Like, how does that work in terms of what people have to think about, whether they're ready to do it, or you know, what pieces they need to have in place to do it?
I think the biggest thing is if you're going to buy a vacation property, it's really looking at your lifestyle or art. How much are you going to use it, right? Yeah. We've had some people that you buy a place and I'm going to use it 4 months of the year and I'm not going to go really travel internationally or to the States. I'm going to focus on staying here and use that property. And then they use it 2 weeks a year, right? And they end up wanting to travel more. And now they have a place that they've closed on and paid a mortgage on and closing costs, et cetera, that they don't really take advantage and use. Yeah. So I think that's a big one, is people got to really figure out, is it something that I'm committing to using if I'm going to be paying for it, right? And that's maybe why if you're buying with family or other people, it's great because you're able to spread out those costs. And you
get more use out of it too, right?
Exactly, beyond more people. Yeah. But rate-wise, you're going to pay the same rate whether you're buying a vacation or secondary place, you're buying your primary. Qualification would typically be a little bit harder because now you have to debt service your existing home mortgage plus the vacation property, right? Right. But most people, I think, who are buying a vacation property are people that have the means and they have the assets, income to be able to support 2 properties.
How much equity would you have to have in your current home? Like if you're refinancing, right, to pull money out, you obviously have to have at least 20% down.
You can actually do a vacation 20% property with 5% down. So
you can?
Yeah, CMHC actually has a vacation second home program.
Oh, they do? Oh, interesting.
You can do 5% on the first, 500,000, 10% on anything above. Okay. If you want to do a vacation property. Okay. Some areas, depending if it's more remote, maybe they need a bit more down, or you would do a 20% down payment just to avoid CMHC.
So it's pretty straightforward.
Yeah, people can either take that equity out of their own assets, investments. They could take it out of equity in their home via refinance, line of credit, or a combination of.
Okay, cool. Yeah. And speaking of not wanting to go to the States, another trend we've started seeing is people wanting to move up from the States. Yeah. So in the last year, I wouldn't say a flood of people, but definitely on our listings, we've seen more, and we've had a few clients reach out who are expats living in the States. Tends to be more California and Portland for what we've been seeing.
A lot more West Coast.
Yeah, more West liberal. Coast. Yeah, more liberal areas. And they're wanting to move up when you ask them for them. You know, it's political. Sometimes it's just lifestyle. It seems to be a lot more seniors than younger people. What kind of but then people are always concerned about financing options, right? What kind of programs are in place for people who are Canadian citizens but living abroad and wanting to buy here? Is it challenging? Is it more challenging? Is it
and it's crazy. I would say I probably get 6-7 inquiries a week.
Oh, you do?
Now, a lot more than we would ever get before. Some are Canadian citizens. They've worked and lived abroad. They want to come back home. Yeah. Some of it's political reasons. Some is just the timing. Maybe they have kids, aging parents. Yeah. They want to come back home and buy. But actually what's interesting is we've had a lot of people that are non-resident Canadians, no ties to Canada, live in the States, Canadian citizens, and they're buying vacation homes here.
Oh, they are?
Really in a response to the political climate. Yeah. So they've just I have a friend that I met that lives in the Sunshine Coast or lives in the Okanagan or, in obviously one of the foreign buyer banned areas that they can buy in. And they've just come up and they've loved it and they want to spend more time here. Yeah. So that's what is really interesting, is seeing more of these non-resident Canadians wanting to spend that maximum 6 months here just to spread their time.
And how does the financing look like? Is it pretty, how does qualifying for someone like them look versus a Canadian citizen?
So if you're with RBC, and again, every lender is different on what they could do. So just for us, if you're either earn income in the States, whether you're a Canadian citizen, non-resident, working, let's say in Seattle, et cetera, or you're just a non-resident, no ties to Canada, U.S. citizen, we would lend based on your U.S. income, assets, credit. Okay. So just like how you and I would qualify for, we'd verify income in the States, we verify credit, we can pull U.S. credit bureaus and verify assets. And they can actually get a mortgage in Canada with 20% down.
Oh, so it's the same.
So just the same as what we
Didn't
can
it used
get.
to be 35%, or is that non-US?
Yeah, that would be non-US.
Okay.
So if you have like UK, Australia income, we have a list of certain countries where we can lend with a bigger down payment.
Okay.
The biggest thing for those clients, if they're buying here, is one, really talking to a lawyer, just to make sure that they understand the foreign buyer ban, they understand the area that they want to buy in is available to buy.
Yeah.
And for some people that if you're US or non-resident Canadian and you don't file taxes here, if you're going to buy a property that's going to be revenue generating,
the withholding tax.
That 25% withholding tax. And then what is it going to look like filing taxes in Canada? Right? So really talking to an accountant, I would say talking to your US accountant and Canadian. And then also talking to a lawyer.
Okay. But the financing piece is easy.
Yeah.
Okay.
But the financing, I would say, is very straightforward just because we can do everything
to go
simply just like I would be for you and I.
Yeah. What about Canadians buying property in the U.S.?
Yeah.
So there's some places still that
we have some of those, right? Whether it's Florida or certain other warmer areas.
Yeah,
exactly.
What does that look like for a Canadian?
Yeah. So with RBC, because obviously we have branches in the U.S., we essentially have a referral program that anybody who's Canadian wanting to buy a property in the U.S., it'd be done through our U.S. division.
Okay.
And we just send a referral off and a colleague would reach out.
Okay.
We obviously can't do it because we're obviously based on our Canadian division, we'd only finance Canadian properties.
But it's fairly straightforward. Like in terms, do you know down payments?
Typically 35%.
So it is a bit more.
Yeah.
Okay.
And rates would be based on rates in the States, which obviously are currently higher than what we have today.
That makes sense. Good. And I think, the other thing, so U.S. citizens we have buying here, Canadians buying in the U.S. is happening. The big thing that we've seen, and you've really helped us with in the last year, is our own clients who are buying and selling and managing that transaction. And in this market, it's really harder than ever in most cases, especially if people have kids, right? So typically you either have to buy first or you sell first. In a really hot market, you want to buy first because then you're more worried about finding something to buy than you are selling, right? And so in a hot market, it was pretty easy. People are just buying, then their property was selling. In this market, it's very risky. You said you've seen some buyers. Thankfully, we haven't had any. We've strategized with our clients, but people who have bought and then they weren't able to sell before closing. Right. And what does that look like?
Well, you're right. Because I think before the challenge was always like in a
just
hot market, finding something that you could get, right? And then you weren't worried about selling because your place is going to sell within a week, couple weeks or a month, right? So now what we're seeing a lot is that like when clients are coming to us, hey, I want to upgrade. So I want to sell my condo and I want to get into detached. Typically what we're going to do is like, okay, what's that worst case scenario? And the worst case scenario is you find that home you want to buy and you're not able to sell, let's say, your condo or your existing property before closing, right? So we always want to be prepared on the most negative scenario because in this market, we just don't know, right? So if we have a client, like I had a client last week, right? Bought a detached house, but that client had help from family. So parents were able to help with a down payment and part of their own money to be able to close on the purchase first. And then the client has a budget in place that if they had to carry both places
they could do it
for the next 6 months, their existing home and then the new, they can afford it. And for them, because it was the right place that they found at a great price and they were very specific on what they wanted to buy, they were willing to take that risk where they're going to probably have to make double mortgage payments for the 6 months, 4 months, right? Other clients, like if they don't have additional cash to put down, whether it's equity in their home, money from family, and all of their down payment is really coming from the sale of their home, then likely they're going to have to write subject to sale.
Or sell first. So like the other option is you sell first and then you buy, which, if you're young and, we've had this sometimes with couples and they have two places to go to, that's fine. But when you have kids, people are really worried about, not being able to find somewhere to go, right? And
I think it's so property specific because even in this market, if you have a really good property and it's priced well, it's likely going to sell in a reasonable time, right? So
I think the risk in this market though is like what we have to go through with clients is most of our clients thankfully have places that are sellable. We're not actually worried that they're not going to sell, but there is a risk, right? Like you could be budgeting on, $1 million and what if you're getting offers at 900, right? Or 950, like you have to be able to make that shortfall.
And that's what we're really doing, right? When we're budgeting for clients going, okay, here's your pre-approval amount. You can buy up to, let's say, 2.5 million, right? Well, I think I can sell my condo for 1.5. When we're doing the math, I'm going, okay, well, what is it going to look like if you sell at 1.3? So we're taking a way more pessimistic number, even then say what their realtor would think on the worst case scenario, and do those numbers work, right? Because I think clients need to be aware that there's probably going to be that variance of what they're going to sell for, and how's that going to affect their payment going forward. So we have had quite a few clients where they have equity in their home. We're able to leverage that equity. They can carry both places if they have to. And many times when we approve them on this worst case scenario, they end up selling and buying. And we don't need that scenario to go through, but we just have it in place and they're fully aware of what it's going to look like if we have to go that route. And it gives them confidence, right? That they know, okay, our worst case scenario, we can budget for it. We're okay with those numbers and willing to take that risk.
And sometimes it works out better. Like we had clients this year that you helped, you know, they wanted to sell their house on the east side, move over to the west side. A lot of our clients are engineers, so they're super conservative. So we're going through like worst case scenarios. And if they're okay with that, then we go ahead. They bought and then they ended up selling for, you know, $200,000 more than they budgeted for, but they were very conservative with their numbers. So I think in this market, you know, well, I think they always say, but I think in this market especially, you should like plan for the worst, but hope for the best. Right.
But this is
and
how
if you do that, you're good.
It should be, right? Like not when we look back and, you know, the busy times of 2016 or even, you know, from COVID times, right? Like we should always have this planning aspect and not just like putting an offer in a place and hoping a place is going to sell with no backup plan, right? So again, back to fundamentals, like you said. But I would say a lot of clients right now, it's a great opportunity. If they have stable jobs, they're, you know, not worried about their employment changing or being downsized. They can comfortably afford the payments to be able to get into that detached house at a reduced price. And or having the option. We had another client in Mount Pleasant that you helped with, I know, and she had her condo. They wanted to buy a townhouse. And we were looking at the scenario, what if the condo didn't even sell? Could they hold it? And they said they could. So then it's not a risk, right? Then you buy it. It's just more of a risk. And you had to rent it out for a year, couple years until
and you can make it work.
Where you could sell it.
So as long as you have your basis, you know, you have A, B, C, and you know you're okay with your worst case, it does seem to work out.
And if a client doesn't have those options, right? And then we've exhausted all of those, there isn't equity, there isn't additional help, or they can't qualify to carry both, then again, the option would be either you're going to be selling first and then buying, right?
And then your risk is just possibly having to rent or going to stay with family.
Short term, or a subject to sale offer, right?
And I think that's the thing that people, there is a lot of doom and gloom in the market. It's a really challenging market, but it's these times that you have the opportunity, right? And like these opportunities to strategize. Those clients who move from, you know, the east side to the west side, you know, they maybe could have gotten an extra $100,000 in the peak market for their house, but they would have paid $300,000 more on the west side, you know, at that same time.
It's crazy because now that price from east to west really isn't as big anymore.
That's what I mean.
You know, like obviously the lifestyle is way better for them and the location is better for their family, but it wasn't a big price difference.
No. So it was a real opportunity, right, to take advantage of it. So what else do we have here? What else is going on, Stephanie?
Lots.
What else did we have? We talked about investors. We talked about, actually, the other thing that, you know, the other trend that we're seeing, and I'd like to get your input on, is downsizers, right? So now's not a great market for downsizers relative, like when the market's really hot, that's when it's good for investors who are selling, and it's great for downsizers, right? Because they're selling high and buying high, but at a lower price. But that said, people still have a lot of equity gains in their properties. We've had some downsizers who made great moves last year to be closer to family and, you know, even just downsizing their investment portfolio. What are you seeing now in terms of downsizers being able to access their equity in their home? What kind of moves are you seeing them making on the financial side? And
I would say a lot more like, say, retirees or people that maybe are getting to the point in the next 5 years where they need to get out of like a detached house. It's too much maintenance. They maybe need to go into a condo, something smaller, or maybe some kind of assisted living scenario. A lot more people are looking at like taking equity out of their properties, whether it's like they need to supplement like support care, right? Or help kids or like pay for extra stuff to accommodate their house. A lot more of that, but then a lot more people are just staying put, right?
I think so too,
And I think instead of like selling and downsizing, they're just getting support and getting help and pulling that equity out to be able to stay in their homes. And again, these are people that if you bought your home 20, 30 years ago, right? They've seen these fluctuations in the market, right?
Well, then it's funny. Some of them, we had a lovely client last year. She was in her 90s and she was just awesome. Some of them don't even realize almost the equity they have in it. She bought her home for $200,000 in the 90s, and now it's sold for over $2 million, right? And it's like those numbers are kind of hard they don't realize that they actually have that kind of wealth. You know, worried about the moving cost being, I don't know what it was. I think it was $10,000 or $20,000 to move to Ontario. And she's like, oh, but when I moved here, it was $2,000. And I'm like, yeah, but your house was $200,000. Now it's $2 million.
Yeah.
But the reality is like she needs that to get into a retirement home and get the care, right? Yeah. And they almost don't realize how much equity they have in there, but at least they have the flexibility to have those options.
Totally.
Which I do think is a lesson. I think a lot of young people also look at, these boomers who have equity in their homes, but really that is the magic of buying, is that when you look at this in 30, 40 years, you have the equity to be able to stay in your home, right? So you're not getting kicked out, or you could sell your home and get care or do something else. But if you don't, right? If you look at those same people who had moved to Vancouver in the 90s and didn't buy, it's a lot tougher for them to make numbers work right now, right? So it's a lot more options when you have that equity.
And I've had a lot of clients, the same thing, right? Where it's like, well, I've had a cheap rent, right? Yeah. So I've just continued to like pay my cheap rent. Yeah. And some clients, it doesn't make sense to buy. If you have a really reduced rent in a good location, you're happy with your space, and you can take your extra income and invest it.
That's a key though. Yeah.
Then maybe for those people, it doesn't make sense because the actual housing costs per month, when you factor in property taxes, insurance, mortgage, strata, et cetera, would be more, and you could invest that. But the difference is, if somebody's investing it, great, or if somebody just taking that additional income, that's the thing, and not investing it, right? And
that's the thing. I think either way is like you said before, is not looking at your real estate as like you're not looking at your house as your investment, that's somewhere to live, but looking at where are you building your wealth, right? And what is your long-term plan? And is that part of it? And if it's not, making sure you're compensating somewhere else. Yeah. Because I do think that's a real risk for people our age, right? And we're building a lot of rental housing, and that's great. And, rents have come down, which is great. But again, rent control only really protects people if they're staying in that same place for 20, 30 years. Exactly. Because you could have a low rent on a one-bedroom condo, but then if you're moving when you have kids and your rent keeps going up, I've met a lot of older people who really the difference in like 70-year-olds I meet in terms of their comfort and their lifestyle now is if they own property and or invested, they're fine. And if they weren't and they were renting and just working, it's a really tough time right now to be a senior, right?
And then you're on a reduced income at market rents today. Yes, rents have come down, but not to support like a pension income. Yeah. Right?
And at least if your place is paid off, even if there's no equity gain, you have somewhere to live for free at that point, right? Other than your
But there's lots of options too, financing wise. So like, most banks nowadays, it's not just that we look at income, right? Yeah. It's not like 20 years ago or 10 years ago, it's like your income is this whole thing. Most banks have programs now where if clients have a reduced income, whether you just have, say, a pension income, and you don't traditionally qualify for that mortgage, they would look at their assets. They look at their RIFs or their RSPs or their investments, and they can lend based on their client's whole financial picture, not just income. Yeah. And that's how a lot of I see seniors are getting financing or being able to take equity out of their homes. Yeah. Even if you're going to use that equity like a reverse mortgage to supplement your income, is qualifying based on your kind of investments or assets.
Well, let's actually talk about the mechanics, because one thing we're seeing, I had to deal with this with my parents, and I'm seeing a lot of clients deal with it, where their parents have their primary residence paid off, right? They may have some investments, but it might not be huge. They want to buy a new property, right? But again, they're in that boat where they don't typically want to buy they don't want to sell before they buy, because they've been in their home for 30 years. They don't want a short-term rental. But how do the mechanics of unlocking that equity in order to be able to buy when you have no income? Like, how does that look for, say, someone who owns a home for $1 million and they want to downsize to an $800,000 condo?
So like the caveat would be, it has to be somebody that has some type of investment, right? If you have minimal income and minimal assets outside the equity of your home, you're not going to have a lot of options with like an A lender, because banks typically aren't equity lenders, right? Banks are going to be either a cash flow lender, so cash flow based on income, your obligations versus your income you're bringing in, or your assets, right? So typically, again, RIFs, RSPs, TFSA, et cetera, right?
So what would be, like just as an example, because I always find it's easier when you have, say someone owned like $1 million property, right? And then they're wanting to downsize to a condo. What would be considered minimal other assets versus like what threshold would be?
$250,000 probably in that range. Yeah. And I would say like that's, if you're somebody that had a working career, you had a decent job with a pension, maybe you'll have that between you and your spouse, et cetera. cetera, right? And again, that's all would be all your investments.
So if you have that, what products do you have available to you to be able to make that move?
So typically in that scenario, if you're downsizing, like we could do a line of credit against their current home. Let's just say they're downsizing from $1 million property to like a $600,000 condo, right? We could do a line of credit, either a combination against the new property and the existing.
So they could buy
the new property, with cash, right? So there are obviously going to be making an interest payment on that line of credit. And then when they sell their current home, that line of credit's paid off. And then they're able to keep the additional cash or net sale proceeds, right?
Okay. But then what's the max you could get on a line of credit? Because it's not 80%. 65. Okay.
Yeah. But then if there's two properties, so there's a new property you're buying and then there's the existing, you would look at like 65% total on both.
Right.
But for a lot of older people, that is what we're looking at, right? Because you're right, it's stressful for them to be able to sell a place and not have somewhere to go.
Yeah.
They want to be able to like secure that property.
Absolutely.
They're okay to make those payments for that couple of months if they're in between owning two places.
Yeah. So that makes sense. So the key is, I guess, having the property paid off, but also having other assets.
Yeah.
And then making sure the place they're downsizing to ideally is 65% or less of the value if they don't want to have to pitch in other funds. And I guess temporarily they could borrow from their assets if they needed to make up that shortfall. Yeah. Okay. And then what about the other thing we've seen this year too is clients who are wanting to buy and renovate, especially, people are buying detached homes or older townhomes, which is where a lot of the value is now. They need the money to be able to renovate, which is upfront cash. How does that work for approvals in terms of, what can you qualify for? What do you need to like have in place to be able to qualify for a mortgage like that?
And a lot of people don't know about this, but I would say most people, if you're getting into like a detached house and you're looking at a $2 million price point or higher, like just to get a 20% down payment is like a feat of its own, right? Like to be able to come up with a $400,000 or $500,000 down payment, then you have your closing costs and then you have your moving costs. That's a huge amount of money, whether you're getting it from your savings, family, your equity of your existing home you're going to sell, right? Yeah. So not a lot of clients that we see, if you're making a jump from, let's say, a strata to detached, have that extra cash to be able to do renovations. They find a great home at a great price, a good location, has all the bones and the layout they want, but maybe it's just dated, right? So with RBC, and most banks have these types of programs, you could do like a renovation mortgage. So we call it like a purchase plus improvements mortgage, where if somebody wants to do cosmetic renos, so we're not talking about tearing down half the house and restructuring it, that would be a construction mortgage.
Risky.
But, if you want to do kitchen, bathrooms, flooring, cosmetic stuff, you can add in typically 10% of the purchase price of the property up to $100,000 for renovations. Okay. And for us, it's actually great because clients would come to us, they say, hey, I think I'm going to do, an IKEA kitchen or a couple bathrooms. It's going to be $85,000, right? They would just give us a list of like the scope of work they're going to do.
So RBC looks at that.
We add the renovation money into the mortgage. So you're actually paying the mortgage rate for the total amount. Okay. And essentially once the work's complete, we advance that money to clients. So clients would have to use a credit card or like if they have a contractor.
So they have to pay it initially and then they...
And we just do that because we need to know that clients have actually done the work to improve the value of their home. They didn't go out and buy an RV, right? And we're giving them money to pay for that.
And they would need to have minimum 20% down in order to qualify for
so actually CMHC's, mostly insurance companies, there's 3 insurers in Canada that we would all use. They have these types of programs as well that you can do it through the insurer. So not necessarily a 20% down.
So in theory, you could buy with like 5% down plus add in your money for your reno.
Exactly. So then clients typically, if you're going to use a contractor, maybe they have a payment plan like net 30, contractor would do work, you pay a part of a deposit, and then when the work's done, they just would give us the invoices and receipts to confirm work's done, and then we advance that money to clients. They can pay off whether it's, paying back their own funds, credit cards, or contractor.
Oh, that's great.
But it's great because most clients don't know about the stuff and they've kind of given up looking at properties that maybe fundamentally meet what they need, and it just isn't like their aesthetic. Right?
Yeah, and to be honest, like until this year when you helped us with our client who did that, I didn't really know that was still a thing banks did. I thought they had tightened up on that. So that is really interesting then.
Yeah, and it's pretty straightforward, right?
Yeah, that's very cool. One more question too I have about... it came to mind as we were doing this when parents are gifting kids, because sometimes parents will gift the money for the reno or they'll gift the money for the down payment. The risk with gifting money, right, is what happens to that. Say you're gifting it to a kid and they get married and then now there's a separation. Has your gift, now gone 50-50 with the other spouse? What are you seeing people do? What are your advice and tips? What would you do if you were gifting, your son, who's
Yeah.
too young to buy.
Yeah.
But if he was ready
Yeah,
to
yeah.
buy, what strategies are you recommending for people
Yeah.
to do to protect that wealth so it
Yeah.
stays in the...
So I think a big thing is that when parents come and say, hey, I'm going to gift money,
Yeah.
100,000 to kids. And a lot of parents will gift money because most people can't save up 5, 10, 15% down payment when they're paying rent prices in Vancouver.
Right.
So very common that I would say a lot of clients that we see buying their first home or even second, parents are gifting money.
Right.
And a lot of it maybe is early inheritance. Parents want to help the kids now when they need it and not help them when they're older and they're not here, right?
Yeah.
So big thing would be the estate planning, right? The parents, if they have other kids, right? Are you adjusting your will based on I'm giving, Johnny over here 100,000 now, but the other 2 kids, maybe they're younger and they're not ready to get buy a home, right?
Mm-hmm.
So looking at their will, and then secondly, looking at how are they protecting that gifted money? Because you're right, I've had a lot of parents that would come gift large amounts, 400,000 to 500,000. And then they're not worried about, what's going to happen to that money if that couple breaks up, right?
Yeah. Yep.
But technically, if that's their matrimonial home, they're both living in that property and they're contributing to it and they sell it down the road, well, that's equity that they're going to split, right?
Yep.
So a lot of parents I'm finding now would have like the couple do cohabitation agreements, which I always recommend people doing regardless.
I think so too. Yeah.
If you're not married, because it just kind of outlines who's bringing what into that relationship, and then what happens if they end up selling and they want to sell that property. Does each person get their portion of down payment back, and do they split the rest of the net sell proceeds or loss if they sell down the road, right? So that's a big one, doing a cohabitation agreement up front before you even finish signing a contract and making it final, right? A lot of people, I think, don't want to have those conversations, and it's expensive to get a contract done up. But it's really just clear and transparent. And it's always recommended. And then secondly, for parents, how can they look at protecting their money, right? So whether parents are gifting money, would it be done via a promissory note, meaning when they sell the property down the road, that money could go back to the parents. So working with their parents, like financial planner, investment advisor, to look at the strategies and options to protect their money. And those are conversations that really need to be had before people buy a house. Because lots of times they'll come to me and it's like they're in the middle of putting an offer, it's exciting. And then I'm bringing up these conversations that they need to have. And it's just, it feels too rushed, right?
What would you do if it was for your... If you were gifting money to your son,
I would say cohabitation agreement for sure. And that's to protect both sides again, right? If they both saved up money. Exactly, right? Put money in the transaction, getting their money back. That's number 1. And 2, probably looking at doing a promissory note. Just to ensure that money would come back to us if they ever
And how
separated.
does the bank treat that if it's a promissory note, or if it's a gift? How do banks treat gifts versus someone's own down payment? Is there a difference in it or not?
Obviously if it's your own down payment and money, we just verify a 3-month history of your money, and that's really for AML purposes to understand that you've accumulated this money in savings and where it's come from, right? If it's typically a gift, we would get a gift letter signed by parents and then just proving the source of where parents are getting their gifted money from.
Okay. So it's fine. It doesn't really... Okay.
But again, I would say these conversations, typically a parent's financial advisor, investment advisor will bring up these conversations.
A lawyer, accountant.
Will be done ahead of time.
And what about, I don't know if you're seeing, but so we're also seeing people with aging parents, and and this is more of a financial advisor, lawyer question of how they're kind of distributing equity. But kids trying to go on title so that it's protect. Are you seeing challenges with that on the mortgage? If a kid wants to go on title, right, with their parents, because the parents are, might have health risks or issues. Does that, from a financing perspective, does that trigger any issues?
I would say if parents own a clear title property, so they have no financing, and they're going to have all of their kids or one of their kids, whoever, go on title, no, because the parents don't have a debt attached to that. But lots of times we've seen where parents have mortgages, have lines of credit, kids would go be on title with the parents. And now those kids want to go buy something else on their own. And now there's a challenge with financing because they're attached to their parents.
And what happens in that scenario? Sometimes the bank just won't.
Well, sometimes we have to have the parents then come on with the kids, because we need
interesting.
like double income to be able to qualify for both.
For both.
Yeah.
Oh, interesting. So then the kids stay on the parents' property, but then the parents are coming on
and
the
then it
kids'
just gets
property.
messy and complicated. I would really think when kids are looking to be added to their parents' property, the conversation needs to be like, what are their plans long term?
Right.
Are they looking to buy and sell? Right? Do they think that's, if they are, how is that going to impact them going on their parents' financing or property first? Right.
Yeah.
So more like looking at that first. And then if they say, no, we're in our long-term home, we're not planning on taking out more financing, we're settled where we are, then maybe it's going to be okay.
Yeah, that makes sense. And then with that, actually, I just had a question that slipped my mind here. But what was it about kids going on to parent properties and then parents helping kids buy? Well, yeah, another question, actually, this was it, is we're also seeing couples splitting up, right? Which is just kind of a life cycle. If people buy a property together and then they split up later on, what does it look like from a bank in terms of how easy is it for someone to get the property in their own the mortgage in their own name versus
like 5 of these right now.
Are you? Yeah. So tell me about this because we are starting to see a little more of that.
So like let's say, couple A and B, they own a property together, primary residence. Person A is going to buy out person B.
Right.
So person B is going to go on move to buy something else. Typically they would go get like a separation agreement drawn up. And obviously that would cover off like support payments, spousal, child support, custody of kids, custody of pets, division of assets, right? And part of that division of assets is going to be like, how is this property going to be broken down, right? So first they're going to determine what's the sale price, right? So it's not typically an arbitrary number that they pick. They may have a realtor come through or a couple of realtors.
Sometimes they get 2 appraisals, right?
To do a market analysis of what they think, and they may get 2 or 3 independent appraisals. And then from all of that, they together would decide what that value of that home is. And essentially, it's just a purchase and a sale, right? If you think of it, person A is the buyer. They're buying the rest of the ownership of that property from person B, and person B is the seller. So each person has to use an independent notary or lawyer to each represent their side.
And that triggers property transfer tax too. Or I guess if they're joint tenants, it doesn't, right?
No, it wouldn't,
But if they're tenants in common, does it?
I don't actually know.
Okay.
Yeah.
We'll find out.
I'm going to find out now. But so, and most couples would be joint tenants, right? I don't see it very common whether they're not. So essentially, it's just a purchase and a sale, right? You'd have the person A has the buy side, person B has the sell side, and essentially the title's transferred and person B gets their cash, right?
Okay.
And then person A would need to qualify for that mortgage fully on their own, because now they're owning or buying the other half of that property.
And does the bank look at it just as if person A was buying it now, or do they look a little more favorably? Like, is there any considerations made to make it easier for that person to qualify?
I would say we treat it the same as it's like a regular purchase. Okay. So like if, person A has to make $5,000 a month in spousal support to person B, well, then obviously it's going to be more challenging because we're factoring
because you guys do factor that into the lending.
Because part of that separation agreement is not just to look at the division of assets and what the buyout of the house looks like, but like what are the financial obligations for person A or person B, right? So it depends, right? And most times, like if they're a long time client and are we able to like help make it work? Yeah, but you're just going to be standard qualifying.
Right. So it could be challenging in this market then, especially if they have...
Well, especially now
if their payments and rates are higher and values are...
I think the value piece is hard because that's what I'm seeing a lot of. Usually it's one person thinks the home's worth a lot more and the other person wants a lower value because obviously...
they want to buy them out.
They want to buy them out, right? So it's coming to that negotiation in the middle, but no different than what you see. You have a buyer and a seller and probably in conflicting sides of what a value is worth and trying to meet in the middle.
We keep saying that in last year, it's like, sellers' expectations are here. Buyers' expectations are here. Sellers are here. And a lot of deals we're getting done is like nobody's really happy somewhere in the middle. And like that's usually where the actual market value is, unfortunately. Right? But both sides are almost equally unhappy. is the tough thing. So,
but I would say most times for those kind of spousal buyouts or people separating is just getting that separation agreement is the first step because they need to determine what are they dividing, right, before they do anything, right? And a lender isn't going to be able to give financing on a buyout if we don't have a separation agreement.
Right. Okay. So I guess if it's happening first thing first, they should do their separation agreement. Then they talk to a lender. That's number one. And then if someone's refinancing or their mortgage is coming up for renewal, back on that wave train, how early do you think they should look? I'm trying to get down to the practical tips now. Like if your mortgage is coming up for renewal in June of this year, let's say, at what point should you start shopping around? What steps should you be taking, and what questions should you be asking before you make a decision?
Okay, let's talk about this.
Okay.
Because I think a lot of people that we see,
Yeah.
Getting a mortgage is not exciting, let's be honest, right? But if you own a home and you don't have it paid off, it's just a necessity, right? So I think because most people are renewing from low interest rates in 21, 22, you're coming into higher rates. A small minority of people took a mortgage out in 23, right? When rates were 6%, and those people are great.
And they love it.
Doing it right away because rates are coming down. But let's say majority people, it's going to be renew at higher rates. People don't want to deal with it, so a lot of people just put it on the side burner, and then it's through 3 weeks to renewal, and you're dealing with it last minute, and you don't have the time to properly shop around. So this is my advice to anybody on a renewal, regardless of where your mortgage is. One, you need to start shopping at a minimum 4 months before renewal. The reason I say 4 months is that most lenders typically are going to hold interest rates 90 to 120 days. At RBC, we're 4 months. So if you're shopping for a mortgage 6 months out, you can, but you're not going to have a rate that's held until your renewal date. So really 4 months would be your start, right? Number one, you're going to go to your own bank first, right? Because wherever your mortgage is held, usually interest rates can be lower with your same lender. Because when a lender is renewing a mortgage, they're not paying, say, a broker or a specialist. They're not paying all these fees and costs to acquire a new mortgage, which become more expensive. So usually when a client goes to their own bank where the mortgage is held or credit union, they're going to get a better interest rate, right? Get that rate first, and then they need to start shopping around, right? I would recommend most people checking 2, 3, 4 different lenders, variety of different lenders to check what interest rates are,
and
right?
just being upfront that, hey, my mortgage is coming up for renewal. What do you guys
have to offer?
But
as a consumer, I don't know why people feel like it's not like it's your mortgage. You're paying your hard-earned income to make that payment. When you go buy a car or you go buy furniture, most people are shopping around for different products and different deals, right? It's going to be the same with your mortgage. And you can just say, hey, I have a renewal. I'm shopping around. I want to understand what the best rates you can offer. I'm comparing my options with other lenders, right? Figuring out what those rates are, right?
And one of the questions you would ask is, what's your rates, right? And right now you're looking at fixed versus variable, which is also
so when clients come to us, the conversation that we have would be, hey, what's your best rate? And then I'm going to dive a bit deeper and say, okay, well, what's your plan? Are you looking at moving in the next 3 to 5 years, right? Because if you are, then maybe the type of mortgage you're going to take is going to be different, right? Are you 10 years to retirement? Are you wanting to pay off that mortgage faster, right? So if they are somebody aggressively paying down that mortgage, then the types of prepayment options available with each lender would be better for that person.
And what's going to save them more in the long run?
Exactly. Is cash flow more important? Are you a young family or a young homeowner who wants cash flow because I'm renewing from a sub 2% rate to rates in the high 3s, right? So asking these questions as like a mortgage professional to understand what's important to that borrower is key to really providing that advice, right? So that's why people need to shop around, get different options. And then again, look at the options. If it is cash flow and you want a lower payment, how can you achieve that? Do you have like an accelerated biweekly payment where maybe you could just pay a regular payment? Could you switch to monthly? Could you do a non-accelerated payment? Can you extend out your amortization? Do you have other high interest debt that you're making payments on that you can consolidate to like bring your overall monthly payments down, get a lower borrowing rate? So looking at all of those different options it's going to be important, and people need time to digest options. And you can't do it when it's 2 to 3 weeks before renewal and you're rushed. Right?
So start 4 months in
4
advance.
Months before, shop around with different lenders.
Be clear about like what your goals are long-term
plans are.
And ask the mortgage advisor, like make sure that mortgage advisor understands the pros and cons. Like that they're not just, okay, here's a rate, go take it,
because
right?
sometimes with certain lenders, like, and there's certain niche lenders, maybe they have better rates, but maybe their prepayment options are less, right? Or have less flexibility, which isn't a bad thing, but it's something that you as a mortgage holder need to understand, am I willing to take less flexibility to get that rate? And if you are, great. And if you're not, then you're going to shop. And I would say we are starting to see interest rates creep up a little bit, right? So if we look at bond yields, some of the pricing that we can do off of fixed rates, it's a little bit higher today than before. So because we're seeing rates move up a bit, people that have renewal in the spring should be locking in interest rates today, because maybe a rate that you're going to get if you don't shop until March could be higher.
Okay. And what
Right.
are you seeing people go right now in terms of fixed? I know that's always the question.
Yeah.
I know there's no standard answer.
Yeah.
But I am curious of how, because it's shifted a bit in the last 2
Yeah.
years from what I understand. What are you seeing people do
Yeah. So I would say, like, if we look back to 2023,
Yeah.
right, when fixed rates were 6.49, 6.39, they were high, and the highest I've seen in my career in a long time, right?
Yeah.
I would say more people, when we had these conversations, were taking variable.
Right.
Variable at the time was like 7.2. So you're
Wow.
taking a variable rate higher than fixed. But
Right.
you're taking that because we started to see the trend of Bank of Canada was starting their rate cutting
Right.
cycle. So for the people that kind of took that leap of faith in a way, and they had the comfort to do it, they worked out well because now they have variable
Now they
rates
can-
that are sitting mid threes, high
Wow.
threes, right?
And are those people trying to lock in now, or are they comfortable out
I
there?
would say, like, I would probably say 2/3 are doing fixed, a third's doing variable.
Okay.
Some clients are doing variable just because they want to be able to, like, have the flexibility of maybe they're going to sell in 6 months.
Right.
And if they're going to sell in 6 months, then they need a mortgage that's going to give them a lower penalty,
Right.
where a variable would have a 3-month interest penalty versus fixed.
Okay.
So some clients will take a variable because they're trying to mitigate that penalty risk. I would say more clients are taking fixed today, especially just because I think we are getting close.
The volatility and that.
Yeah, exactly, right? And rates historically are back to kind of normal interest rates, right?
Yeah.
So, and I think people with all the volatility in the world want a set interest rate, a set payment, and not have to think about it.
Yeah.
Right.
Well, Stephanie, you've been a wealth of knowledge. I think we're on our time here.
Right.
If people want to reach out to you, what's the best way for them to reach out to you?
So email address, stephanie.camps, so CAMPS @rbc.com, be the best.
Yeah. Or you could reach out to us and we'll send you her info. That's the other
Perfect.
option. Awesome. Well, thank you so much for joining us. This was
great.
a wealth of info, and I'm loving it. And I'm sure I'm going to have more questions for you after
sounds
this.
good.
Talk to you soon.
Thanks. Bye.
Bye.